and welcome to our comprehensive credit guide on home loans, specifically designed for those in Australia embarking on the exciting journey of home ownership. Today we're going to delve deep into the world of mortgages, breaking down everything from the basics to the more intricate details. This video is crafted for an introductory guide for beginners, but we also have insights that seasoned home buyers will find valuable. Let's start by unraveling the mystery of what a mortgage really is and how it operates in the real world. At its core, a mortgage is a type of loan, specifically a residential home loan, that is secured against the property you're aiming to buy. But let's take a step back and compare this with something more familiar, like a personal or a car loan. Imagine you borrow 10 grand from the bank and you buy a car. The bank takes security over the car, meaning if you fail to repay the loan, they have the right to repossess it and sell it to recover their funds. A home loan operates in a similar principle, but instead of a car, we're talking about a much larger asset, which is your home. For example, you have a home valued at $500,000. The bank agrees to lend you $400,000. If you're unable to repay this loan, the bank has the right to sell the property to recoup their investment. This fundamental concept underpins the entire mortgage system. Now let's explore how a mortgage works in practice. It begins with a lender, typically the bank or a financial institution, which agrees to lend you a sum of money. This is the mortgage. You, the borrower, then use this money to purchase your dream home. Over time, you repay the bank in monthly installments. These payments continue until the end of the entire loan term. Once you've completed all your payments, the property is fully yours, free from the bank's claim. This transaction primarily involves two parties: the lender, providing you the funds, and the borrower, which is you receiving those funds to achieve home ownership. One term you'll hear often is 95% mortgage, but what does this actually mean? Essentially, it refers to a mortgage where the loan amount is 95% of the property's total value. Let's illustrate this with an example. Suppose there's a home on the market for $100,000. I know, but let's just roll with me here. A 95% mortgage on this property would be $95,000. This concept is closely tied to the loan to value ratio, LVR, a critical term in mortgage discussions. The LVR is calculated by dividing the loan amount by the property's value, then multiplying by 100 to get a percentage. So in our example, a $95,000 loan for a $100,000 property gives us an LVR of 95%. This ratio is a key factor lenders consider when assessing your loan application. Another important aspect of mortgages is lender's mortgage insurance, commonly referred to as LMI. This is a fee that borrowers pay when their deposit is less than 20% of the property's value, resulting in an LVR higher than 80%. For instance, if you're buying a property for $100,000 and you want to borrow $90,000, which is 90% of the property value, you will likely need to pay LMI for this. This insurance protects the lender in case you default on the loan. Although it's an additional cost, LMI can be a game changer as it allows you to enter the property market sooner, even without a full 20% deposit. In many cases, lenders will let you add the LMI fee to your total loan amount, slightly increasing your mortgage but reducing your upfront costs. Understanding the terms principal and interest is crucial in the mortgage world. The principal is the actual amount you borrow to purchase your home. Interest, on the other hand, is the cost you pay for the privilege of borrowing that money. It's akin to a rental fee for using the lender's money. Most home loans are structured over a 30-year loan term. During this period, your payments gradually reduce the principal amount while also covering the interest charges. This process is visually represented in a graph with the loan amount in one axis and time on the other. Initially, a larger portion of your payments goes towards covering the interest, but as time progresses, more of your payment is applied to reducing the principal. If you choose an interest-only loan, your payments only cover the interest component, meaning the principal remains unchanged. While this can lower your monthly repayments initially, it also means that you're not building equity in your property and your loan repayments are going to be higher later on. So how much should you save before considering buying a house? A good rule of thumb is to aim for a deposit of 5% of the property's value, especially if you're a first-time buyer. This amount should be sufficient to cover your initial costs and secure a home loan. However, if you're a repeat buyer, you might need to save a little bit more to cover the additional expenses like stamp duty and conveyancing fees. If you're in Australia and seeking guidance on securing a home loans, look no further than the team here at Wilbell Mortgage Broker. We specialize in navigating the complexities of the mortgage process and are dedicated to helping you achieve your dream of home ownership. Visit our website and find us on the links below to start your journey. We're here to provide expert advice and support you on every step of the way. Thanks for watching. Remember to like and subscribe. Cheers, guys. Bye.